You ever wonder how someone like me, starting with just a small pile of money, could consistently pull off returns that most people dream about, returns of 50% or more? Well, I'm going to let you in on a few truths. And the first one might surprise you. It's not about luck. It's not about having insider info or some magical formula you can only dream of. It's about understanding patterns, being patient, and thinking in probabilities. Most people think investing is about picking the next hot stock, but that's just gambling disguised as ambition. What really works is systematic thinking, finding edges that exist in the market, and exploiting them in a disciplined way, even if your starting capital is tiny. When people hear about extraordinary returns in investing, the first thing they often think about is luck. They assume that the most successful investors just happen to be in the right place at the right time, that they had a crystal ball or some insider secret that nobody else knew. I can tell you from experience, that's almost never the case. Luck plays a role in the short term, sure, but if you look at consistent, high-performing investors, what separates them from everyone else is not luck. It's the way they understand patterns and think in probabilities. When I started investing, I quickly realized that relying on luck is like building a house on sand. You might get away with it once or twice, but over the long run, it will collapse. What actually works is having a systematic approach and a mindset tuned to probabilities rather than predictions. Most people approach investing emotionally. They hear about a stock that might go up or a market trend that looks promising, and they make decisions based on hope, fear, or excitement. That's gambling, not investing. I learned very early on that the only way to consistently beat the market is to strip away emotion entirely. I don't try to predict where the market will go tomorrow, next week, or even next month. Focus on the patterns that exist within the data and try to understand the probabilities. Every trade, every position, every decision I made was informed by analysis, not intuition. I can't control the market, but I can control how I interpret the signals and apply my edge. That's what makes the difference between short-term luck and long-term success. Another thing that surprises people is how often high returns come from small, incremental advantages. It's not about finding a single perfect trade or striking gold once. It's about identifying small edges that are consistent over time and exploiting them systematically. When you do that, luck becomes almost irrelevant. You're no longer depending on chance. You're depending on a repeatable process. That's why I emphasize the importance of systems and patterns. When you see a pattern that has a higher probability of repeating than not, you can act on it with confidence. Over time, those small advantages compound, and that's how small investments grow into remarkable results. People also misunderstand what it means to think in probabilities. It's not some abstract math exercise, it's a mindset. It's the discipline to accept that nothing is guaranteed, that every trade has a range of possible outcomes, and that your goal is to maximize the chances of success while managing the risk of failure. Thinking this way changes every decision you make. You stop chasing hot tips and start building a framework for consistent, intelligent decision-making. You stop hoping for luck and start creating it through careful, measured actions. What I want people to understand is that extraordinary returns aren't magical. They aren't reserved for people with insider access or huge fortunes. They come from recognizing that investing is probabilistic, not deterministic. You don't need to predict the future. You need to understand the rules, the patterns, and the probabilities, and then act on them in a disciplined way. That mindset separates those who succeed repeatedly from those who are at the mercy of chance. So the next time someone tells you they got lucky investing, take a closer look. True investing skill isn't about luck. It's about seeing what others don't see, understanding the probability, and making decisions based on that insight, not on hope or fear. If you start thinking this way, even small investments can begin to grow in ways that seem almost impossible to someone who relies on intuition alone. It's not luck that gets you there. It's the way you approach the game, the patterns you trust, and the discipline you apply every single day. When it comes to investing, one of the biggest mistakes people make is focusing on things they can't control and letting the noise of the market dictate their decisions. I've learned over the years that the most successful investors don't waste time on predictable events or trying to guess what the market will do next. Instead, they focus relentlessly on what they can measure, what they can control, and what consistently gives them an edge. That mindset may seem simple, but it's incredibly powerful. And it's one of the reasons why small investors can outperform those with much larger capital if they stick to the basics. The market is full of distractions. Every day there's a flood of news, opinions, and forecasts that can make even experienced investors second-guess themselves. People see headlines about a stock skyrocketing or crashing and feel pressure to act immediately, often without any real data to justify the decision. Most of the time, these reactions are based on emotion, not strategy. I've always approached investing differently. I decided early on that I would focus only on what I could actually analyze and measure. And I would build my decisions around facts, patterns, and probabilities. That discipline allows you to tune out the noise and stay on track even when everyone else around you is panicking or chasing the latest trend. Control is a tricky concept because in the market, you can't control the outcome of a trade, but you can control your process. You can control how much risk you take, how carefully you study the patterns, and how consistently you apply your strategy. That's the real secret to growing money, especially when you're starting small. When you focus on what you can control, you stop being reactive and start being proactive. You create a system that works for you, and you trust it to deliver results. Over time, instead of hoping that luck or timing will be on your side, another element of focusing on what you can measure is that it keeps your investment decisions objective. The moment you let emotions dictate your moves, you're at the mercy of market swings. You might hold on to a losing position out of stubbornness or sell a winning one too early out of fear. By sticking to measurable, controllable factors, you remove those emotional traps. For example, instead of guessing which stock will explode next, you focus on statistical edges, historical data, and probabilities. That doesn't eliminate risk, but it allows you to manage it intelligently. And over time, managing risk is just as important as chasing returns. People often underestimate the power of focusing on controllable variables because they assume investing is all about guessing correctly or getting lucky. In reality, the market rewards discipline and consistency far more than it rewards luck. Even small amounts of money, invested carefully in situations where you have an edge, can grow exponentially if you stick to the process. It's the compound effect of disciplined, measured decisions that creates extraordinary results, not guessing the next big stock or reacting to every headline you see. What I want people to take away is that success in investing doesn't come from trying to predict the unpredictable. It comes from identifying what you can influence and making that your focus. By controlling your actions, analyzing the patterns that are in front of you, and ignoring the noise, you create a much higher probability of success. It doesn't matter how small you start. What matters is that you consistently apply a system that works based on what you can control and let the math do the rest. When you focus on what you can measure and control, investing becomes less stressful, more predictable, and far more profitable over time. It's a mindset that anyone can adopt, and it separates those who struggle from those who achieve real, consistent returns. Your results aren't dictated by the market. They're dictated by the quality of your decision, the discipline of your process, and your ability to ignore everything else. That's how small investors can achieve results that most people think are only possible for the very wealthy or the extremely lucky. One of the most important lessons I've learned in investing is that trying to predict the future is a trap. Most people think the key to success is figuring out where the market is going next, which stock will rise, or which trend will explode. The truth is, predicting the future is impossible. No matter how smart you are, no matter how much data you have, there will always be uncertainty. What separates successful investors from the rest is not their ability to see the future. It's their ability to create systems that don't depend on knowing it. I've always focused on building systematic approaches that work based on probability, patterns, and repeatable strategies rather than relying on gut instincts or guesses. That's what gives you a real edge. When I first started investing, I noticed that people who relied on predictions were constantly reacting. They would jump in and out of positions based on news, speculation, or rumors. Sometimes they got lucky, but over the long term, luck is not a strategy. I realized that if I wanted consistent results, I had to stop thinking about what might happen next and start thinking about what I could measure and analyze. Instead of predicting the market, I focused on the relationships between variables, on patterns that historically repeated and on small, consistent edges that could be exploited systematically. Over time, these small edges compound into significant returns. The power of a systematic approach is that it removes emotion from the equation. One of the biggest challenges in investing is that human nature makes us reactive. When markets rise, we get greedy. When they fall, we panic. That emotional roller coaster is what destroys most investors' returns. By creating a rules-based, systematic approach, you make decisions based on logic and probabilities, not fear or excitement. It's not about eliminating risk, you can't do that, but it is about managing it intelligently, so your losses are limited and your gains are maximized over time. That's why systems work even for small investors starting with limited capital. Another key point is that systematic investing allows you to scale your approach. When you have a tested strategy that works, it doesn't matter whether you're investing $1,000 or $100,000. The process remains the same and the results compound. People often think they need a massive bankroll to achieve high returns, but the truth is that a disciplined system applied consistently to small amounts of money can outperform a larger, undisciplined portfolio. The key is to focus on the process and trust that consistent execution will yield results, even if they don't appear immediately. The beauty of this approach is that it also makes learning and improving measurable. Every decision, every trade, every action is part of a process you can analyze. You can see what works and what doesn't, adjust your strategy, and continue improving over time. It's far more productive than chasing hot tips or trying to guess the next market move. In the long run, those who rely on predictions are usually reactive and inconsistent, while those who follow systematic strategies are proactive and disciplined. I want people to understand that investing success is rarely about predicting the market or picking the next winner. It's about building a repeatable process that works under uncertainty. By focusing on probabilities, patterns, and rules-based strategies, you can achieve results. That might seem impossible to someone who relies on gut feeling or speculation. You don't need to know the future. You need to understand the system and stick to it. Over time, consistent application of a systematic approach produces returns that far outpace luck or intuition. When you stop trying to predict the unpredictable, investing becomes simpler, less stressful, and far more effective. You start making decisions based on what actually works, not on hope, fear, or guesswork. That mindset trusting systems over predictions is what separates ordinary investors from those who consistently generate extraordinary results, even when starting with small amounts of money. It's not about predicting tomorrow, it's about playing the probabilities today and letting the system do the work for you. One of the most underrated advantages in investing is starting small. Most people assume that having a huge amount of capital is the key to generating massive returns, but the truth is, starting with limited funds can actually be an advantage if you approach it the right way. When you have a small amount of money, you're forced to be selective, to focus on the opportunities where your edge is strongest. You can't spread yourself too thin or chase every hot tip that comes along, so you learn discipline and precision early on. That focus is something that many large investors struggle with, because when you have a lot of money, the temptation to diversify too widely or to take unnecessary risks is much greater. When I started out, my capital was very limited, and I had to be smart about where I invested. Every decision counted because mistakes were costly. That forced me to analyze opportunities more carefully, to identify small edges that could be exploited, and to stick to what worked rather than chasing what looked exciting. Interestingly, those small, deliberate decisions ended up compounding over time in ways that a larger, more scattered approach couldn't replicate. Starting small teaches you patience, precision, and the value of increment, gains qualities that are essential for achieving extraordinary returns. Another reason small capital can be an advantage is that it encourages risk management. When you have limited funds, you can't afford to take reckless positions. You have to think probabilistically, focus on high-quality setups, and manage your exposure carefully. That's the same discipline that allows investors to generate returns of 50% or more consistently. People with massive accounts can sometimes get away with mistakes because they have more capital to absorb losses, but they often fail to develop the rigorous approach that small investors are forced to adopt. Starting small teaches you to respect risk, and that respect becomes a critical part of long-term success. Starting with limited resources also forces you to concentrate on your strengths. You quickly learn that trying to be good at everything is a recipe for mediocrity. Instead, you focus on the areas where you have the most knowledge, the clearest edge, and the most confidence. That concentration is what allows small investors to outperform larger, less disciplined ones. It's not about luck or guessing correctly. It's about applying your skills where they matter most and being disciplined enough to avoid the distractions that most investors fall into. Compounding is another powerful reason to start small. People often underestimate how dramatically consistent gains grow over time. Even if you start with a modest amount, the returns from smart, discipline investing begin to snowball if you reinvest them carefully. 50% returns on a small investment might seem modest at first, but over several cycles, those gains accumulate exponentially. Starting small allows you to learn, refine your approach, and compound your knowledge and capital simultaneously. It's a training ground that prepares you for larger opportunities later. But the lessons and habits you build while starting small are invaluable. What I want people to understand is that the size of your starting capital is far less important than your approach, discipline, and focus. Small investors have a natural advantage if they are willing to be patient, careful, and strategic. They are forced to develop the skills and mindset that ultimately lead to extraordinary success. The constraints of limited funds create clarity, focus, and precision, the same qualities that allow some of the world's most successful investors to generate returns that others only dream about. Starting small is not a limitation, it's an opportunity. It forces you to focus on what matters, manage risk intelligently, and apply your edge consistently. Those lessons compound just like your returns, and over time, a small, disciplined approach can outperform even the largest, most ambitious portfolios. In the end, it's not the size of your capital that matters, it's how you use it, the systems you build, and the discipline you maintain that determines your success. One of the most powerful forces in investing and in life is compounding, and it's especially relevant when you're dealing with small amounts of money. Most people underestimate just how dramatically compounding can work in your favor if you are patient, disciplined, and consistent. It's not about making a single big win or striking gold ones. It's about taking the small gains you achieve consistently, reinvesting them, and letting them snowball over time. That's how modest beginnings can turn into extraordinary results, even when your starting capital is limited. When I think about my early investing days, what stands out is how important it was to respect the process and let time work for me. I wasn't trying to get rich overnight. I was focused on finding small, reliable advantages and applying them consistently. Every decision was designed to maximize the probability of success, not to chase a jackpot. By taking those small, incremental steps and reinvesting the gains, the growth becomes exponential rather than linear. It's the difference between making $100 once and making $100 consistently every month, then reinvesting it. Over time, those compounding gains far outpace what most people achieve through sporadic, high-risk bets. Compounding works best when you combine it with discipline. If you don't stick to a system or you let emotions interfere, your gains get eroded. Many investors see small profits and think they're not significant, so they either spend them or take unnecessary risks to chase something bigger. That's the opposite of what compounding needs. Compounding rewards patience and consistency. Every decision to stay disciplined, reinvest intelligently, and maintain your edge contributes to a growing cycle of success. Even modest returns, when compounded over time, can produce results that seem almost impossible to someone looking for instant wealth. Another aspect people often overlook is that compounding isn't just about money, it's also about knowledge and skill, the habits, strategies, and insights you build while managing a small portfolio compound alongside your capital. Every time you make a decision based on data, test a strategy, or refine your process, you're adding to your knowledge capital. That intellectual compounding can be just as valuable, if not more so, than the financial compounding, because it increases the quality of every future decision. By the time your capital grows, your skill set has grown even more, and that combination produces extraordinary results over time. It's also worth noting that compounding favors those who Start small because small amounts allow you to experiment and learn without risking everything. Early mistakes are much less costly, and the lessons you gain early compound along with your gains. Many investors avoid starting small because they want instant results. But in reality, starting small gives you the perfect environment to learn, adjust, and develop the discipline needed to handle much larger sums later on. By the time your portfolio grows, you're not only richer, you're also far wiser. The key to harnessing compounding is to focus on high probability, disciplined actions, and to consistently reinvest gains. The market doesn't reward impatience. It rewards those who trust the process, stick to the system, and let time and repetition work their magic. Small amounts invested intelligently, with patience and consistency, grow in ways that most people underestimate. That's why even modest investors can achieve results that seem unattainable to those who rely on luck or sporadic decision-making. What I want people to understand is that compounding isn't just a financial principle, it's a mindset. It's about respecting time, valuing consistency, and committing to a disciplined approach. The sooner you start, the more powerful it becomes. Even small, calculated actions accumulate into extraordinary outcomes over time. That's how I built returns that many thought were impossible. It's not about chasing the next big win. It's about letting the small wins multiply and trusting that the compounding process will deliver. Exceptional results, one of the most critical aspects of investing, especially when starting with small amounts, is discipline. Discipline is what separates those who achieve consistent, extraordinary returns from those who get caught up in the highs and lows of the market and end up losing more than they gain. When I began investing, I quickly realized that having a good system or a strong strategy was only half the battle. The other half was having the self-control to stick to it, even when the market tempted me to do otherwise. Discipline isn't flashy, and it doesn't make headlines, but over time, it compounds just like your investments. Discipline starts with rules, simple, clear rules that guide every decision. When you invest, it's easy to let emotion creep in. Fear can make you sell too soon, and greed can make you take risks that aren't justified by probabilities. Those emotions can destroy years of progress in an instant. By committing to a disciplined approach, you remove the guesswork and the impulsive reactions. You follow the system you've built based on data, patterns, and probabilities, not on hunches or market chatter. That's the kind of consistency that allows small amounts to grow exponentially over time. Another key point is patience. Discipline isn't just about following rules, it's about understanding that results take time. Many investors, especially those starting with limited capital, want to see instant results. They measure success by how quickly their money grows rather than how consistently they're applying their edge. I learned early that the market doesn't reward impatience. It rewards those who stick to the process, even when it's slow or boring, because over time, consistent application of a disciplined strategy produces returns that far exceed the occasional lucky trade. Discipline also involves knowing when not to act. Sometimes the best decision is to wait. The temptation to always be doing something can lead to mistakes and losses. I realize that a patient, disciplined approach means acting only when the odds are clearly in your favor. That doesn't mean you sit idle all the time, but it does mean you resist the pressure to chase every opportunity. High returns aren't about constant activity, they're about selective, disciplined action applied consistently over time. Another element of discipline is tracking and learning from your results. Discipline isn't blind adherence, it's a commitment to improving your approach while following the rules. Every trade, every decision, every gain or loss is a chance to refine your system and strengthen your process. By measuring outcomes, adjusting for what works and what doesn't, you develop a stronger, more reliable approach that compounds over time, just like your capital. Small, disciplined steps repeated consistently produce results that seem almost magical to those who rely on luck or intuition. One of the most powerful aspects of discipline is how it interacts with compounding. Discipline allows you to stay consistent even when the market is volatile or tempting distractions appear. That consistency ensures that your small gains are reinvested, compounded, and allowed to grow over time. Without discipline, even the best strategy fails because emotional reactions lead to mistakes, and mistakes erode gains faster than anything else. With discipline, however, your results become predictable, systematic, and highly effective. I want people to understand that discipline isn't about being rigid or inflexible. It's about creating a framework that allows you to act intelligently, consistently, and patiently. It's about resisting the temptation to chase short-term excitement and trusting the process you've developed. That kind of mindset is what turns small amounts into extraordinary returns. It's what allows investors to achieve 50% gains or more consistently without relying on luck or prediction. Discipline is the foundation that makes everything else possible, and without it, even the best strategies will fall apart. When you commit to disciplined investing, you take control of your results. You stop being a victim of market swings and start being a master of your own process. You learn patience, restraint, and precision, and over time, those qualities compound alongside your investments. That's why discipline is not optional. It's essential. It's the invisible force behind consistent, extraordinary returns, and it's the reason small investors can outperform those who rely on luck, intuition, or impulsive decisions. One of the most important lessons I've learned in investing is that consistency matters more than size. Many people assume that to achieve extraordinary returns, you need a massive amount of capital to start with. They think that the bigger the account, the bigger the gains, and while that seems intuitive, it's actually misleading. What really drives exceptional results isn't the size of your starting capital. It's your ability to apply a consistent, disciplined approach over time. Even small amounts of money invested intelligently and consistently can grow into results that most people would consider extraordinary. When I started, my capital was limited, and that forced me to focus on what really mattered. I couldn't take wild risks or chase every opportunity, so I had to develop a system that worked reliably. Over time, I realized that small, repeated actions compounded more effectively than occasional large moves or impulsive decisions. Consistency allows you to take advantage of the compounding effect, and it builds habits that reinforce good decision-making. Every small gain, repeated and reinvested, accumulates into something much bigger than any single trade or investment could achieve on its own. Consistency also allows you to learn and refine your approach. When you invest in a disciplined, repeatable way, every decision provides feedback. You can see what works, what doesn't, and adjust your methods accordingly. That continuous improvement is much harder to achieve when you make sporadic, large-scale investments. It's not the amount of money that teaches you lessons, it's the process of applying your system consistently. Over time, those lessons compound just like your gains, making you a better, more informed investor with each step. Another advantage of consistency is that it removes emotion from investing. One of the biggest threats to returns is human psychology. Fear and greed often drive people to make decisions that undermine their long-term goals. When you follow a consistent, rules-based strategy, you remove much of the emotional component. You stop reacting to market swings or headlines and instead focus on applying your approach reliably. That steadiness is what separates successful investors from those who struggle despite having access to the same information or capital. Consistency also changes the way you think about risk. When you invest systematically, even small amounts, you're less likely to take reckless gambles or make impulsive decisions. You know your edge, you understand the probabilities, and you stick to the actions that maximize your chances of success. That disciplined, steady approach allows your small investments to grow steadily. Over time, those steady gains outperform the occasional windfall or lucky trade. It's a lesson that many people miss because they equate size with success, when in reality, sustained, consistent effort produces much greater long-term results. One of the most powerful aspects of consistent investing is how it interacts with time. The longer you stick to your system, the more your results compound. Even if you start with a modest sum, consistent application of a tested strategy allows you to achieve growth that seems impossible to someone looking for instant results. This is why small investors, when disciplined and patient, often outperform larger investors who may lack the same focus or consistency. It's not about how much you start with. It's about how reliably you apply your process over time. I want people to understand that size is overrated, but consistency is everything. Extraordinary returns don't come from one-off trades, lucky guesses, or massive bets. They come from repeated, disciplined actions applied over time. Even the smallest investments, if handled with the right mindset and approach, can compound into results that most people consider remarkable. That's the power of consistency in investing. It's a principle that levels the playing field, allowing small investors to achieve results that rival or even exceed those with far greater resources. When you focus on consistency rather than size, you build a process that works, develops your skill set, manages risk effectively, and lets compounding work its magic. That approach is the backbone of long-term success in investing. It's not flashy, it's not dramatic, but it's powerful, reliable, and ultimately far more important than starting with a large sum of money. One of the most overlooked aspects of investing is the role of managing emotions. It's especially crucial when you're starting with small amounts of capital. Most people think investing is purely about strategy, numbers, and picking the right opportunities. While those things matter, the truth is that human psychology often determines your results more than any technical analysis or financial model. Fear and greed are incredibly powerful forces, and if you let them dictate your decisions, they can destroy gains faster than any market downturn. I learned early that controlling my emotions was just as important as developing a profitable strategy. When I started investing, I noticed that even small investors made the same mistakes as those with millions. They'd see a stock drop a little and panic, selling at a loss, or they'd see a sudden rise and buy impulsively out of excitement, only to watch it fall shortly afterward. Emotional reactions like these are natural, but in investing, natural doesn't mean effective. Over time, I realized that success wasn't about predicting the market or finding the perfect trade. It was about creating a system I could trust, and then sticking to it no matter what the market did. That meant not letting fear make me sell too early, or letting greed push me into unnecessary risks. One of the most important ways to manage emotions is to focus on probabilities instead of certainties. Most people invest as if they know exactly what will happen, but the reality is that nothing is guaranteed. Every investment has a range of possible outcomes, and the goal is to tilt the odds in your favor. When you think probabilistically, you stop reacting emotionally to every small movement in the market because you understand that short-term fluctuations are just noise. You focus on whether your edge exists and whether your system is being followed correctly. That mindset allows you to remain calm, rational, and disciplined even during periods of volatility. Another key point is that small amounts of money can actually make it easier to control emotions because the stakes are manageable. When you start with limited capital, you're forced to be selective, disciplined, and patient. You can't throw money at every opportunity, and you can't afford to make impulsive mistakes. That constraint encourages careful analysis and thoughtful action, which naturally reduces emotional decision-making. As your capital grows, those habits stick, giving you the psychological framework needed to handle larger sums without panic or recklessness. It's also critical to develop a rules-based approach to investing. Emotional mistakes happen when decisions are made on the fly without a plan. By creating clear guidelines for entry, exit, and risk management, you remove the need to rely on gut feelings or reactions to market headlines. When a trade goes against you, the rules tell you what to do. When a trade moves in your favor, the rules dictate whether to hold or take profits. This framework doesn't eliminate uncertainty, but it eliminates emotional mistakes that can erode your returns over time. I want people to understand that emotional control isn't about suppressing feelings. It's about directing them. Excitement, fear, and impatience are natural, but in investing, they need to be filtered through logic, discipline, and probability. If you can master your emotions, even small investments can produce extraordinary returns. You don't need a huge account to succeed. You need a disciplined mind that follows a system and trusts the process. Emotional control compounds just like capital. Every decision made calmly, without panic or greed, strengthens your ability to make better decisions in the future, which in turn produces better results. The bottom line is that investing isn't just about numbers. It's about mindset. Emotional discipline is as critical as any strategy, and it allows you to stick to your edge, manage risk effectively, and let small gains compound into extraordinary results. If you start with a small amount and focus on mastering your emotions while applying a reliable system, the returns over time can be far greater than most people ever imagine. It's not luck, it's not instinct, it's the consistent application of a rational, disciplined approach guided by controlled emotion. One of the most important lessons I've learned over the years is that data should drive your decisions, not intuition. Many people think that successful investing is about gut feelings, instinct, or having a sense of where the market will go next. In reality, relying on intuition is one of the fastest ways to destroy your capital. The most consistent, extraordinary returns come from observing patterns, analyzing data, and acting on evidence, not hunches. I built my entire approach around this principle, and it's what allowed even small amounts of money to grow into remarkable returns over time. When I first started, I quickly realized that emotions and gut feelings are unreliable. You might feel confident about a stock or market trend, but feelings don't always align with reality. One bad decision made purely on instinct can wipe out months or even years of gains. That's why I focused on systems that rely on measurable patterns. Instead of asking myself what I felt would happen, I asked what the data showed and how it could inform probabilities. By consistently applying this approach, small advantages started to accumulate and compound, producing returns that seemed almost impossible to those who relied on intuition alone. Using data doesn't mean ignoring experience or common sense. It means combining them in a structured way to increase your odds of success. Every decision I made was tested against historical patterns, statistical models, and probabilities. I wasn't trying to predict the future. I was trying to understand the conditions under which certain outcomes were more likely than others. That distinction is critical. You don't need to know what the market will do tomorrow. You need to know the situations where you have an edge and act on them consistently. That's how small amounts of money invested intelligently can grow at rates most people consider extraordinary. Another key aspect of relying on data is that it removes emotion from the equation. When decisions are based on probabilities and patterns, you're less likely to be swayed by fear, greed, or excitement. You follow the rules, the signals, and the system. You trust that over time it will produce results. Most investors fail because they let emotions dictate their actions. They sell too early, hold too long, or chase hot tips without evidence. By contrast, a data-driven approach is calm, rational, and repeatable. That consistency is what allows even small portfolios to outperform expectations over the long term. Data also allows for continuous improvement. Every trade, every decision, and every outcome can be analyzed. You can see what worked, what didn't, and adjust your approach accordingly. This feedback loop is invaluable because it compounds over time just like your investments do. Even small adjustments based on careful analysis can dramatically improve performance over months and years. It's not magic. It's a disciplined, methodical approach that relies on evidence rather than luck, instinct. What I want people to understand is that relying on intuition alone is a trap, especially in investing. The markets are too complex, and emotions are too strong for guesses and gut feelings to consistently generate high returns. Data, patterns, and probabilities give you an objective framework. They allow you to make decisions with confidence, apply your edge consistently, and avoid costly mistakes. Even small investments, guided by a disciplined, data-driven system, can produce results that feel impossible to those who rely on instinct alone. In the end, the most powerful tool an investor has is information. The way you interpret it, analyze it, and act on it determines your success. By trusting data over intuition, you remove the guesswork, minimize emotional errors, and create a system that compounds over time. That's how extraordinary results are achieved. even when starting with limited capital. It's not luck, and it's not instinct. It's evidence, analysis, and discipline. Application that produces consistent, high returns. That a common misconception that you need a huge amount of capital, insight, knowledge, or special access to achieve extraordinary returns. The reality is quite the opposite. Success in investing isn't determined by the size of your starting capital. It's determined by your approach, your discipline, and your mindset. Even modest amounts of money, when invested intelligently and consistently, can grow into results that many people think are only possible for the very wealthy. When I began, my own resources were limited, and that forced me to focus on building a process that worked reliably. I couldn't rely on luck, I couldn't take unnecessary risks, and I had to be selective about every opportunity I pursued. That limitation became an advantage because it taught me discipline, patience, and precision. Small beginnings forced me to concentrate on areas where I had an edge, analyze opportunities carefully, and apply my strategy consistently. Over time, those small, thoughtful decisions compounded into returns that seemed almost impossible to anyone who believed success was about starting with a fortune. One of the reasons small investors can succeed is that starting small encourages careful analysis and risk management. When your capital is limited, you can't afford mistakes. You learn to manage risk intelligently, focus on probabilities, and make decisions that maximize your chances of success. That discipline, developed in the early stages, becomes a foundation that allows you to scale effectively as your capital grows. By the time your investments reach a larger size, you've already developed the habits, knowledge, and mindset needed to handle bigger opportunities without making the emotional or strategic mistakes that destroy wealth. Another reason starting small works is that it gives you room to learn. Early in investing, mistakes are inevitable, and experience is invaluable. If you start with a modest amount, those mistakes are much less costly, and the lessons you gain compound alongside your returns. You learn which strategies are effective, how to manage risk, and how to control emotions. That accumulated knowledge is often far more valuable than the money itself because it allows you to make better decisions over time. By the time your portfolio grows, your understanding and skill have grown. Even more, creating a compounding effect that multiplies your results. Compounding, both in terms of capital and skill, is the real secret to achieving high returns from small beginnings. Even modest, disciplined investments grow exponentially when gains are reinvested consistently. And while small amounts might seem insignificant at first, the combination of discipline, patience, and reinvestment produces results that far exceed what most people expect. This is why starting small is not a limitation, it's an opportunity. It allows you to develop the habits, systems, and mindset necessary for long-term success without taking on unnecessary risk. I want people to understand that success isn't reserved for those with massive capital or access to insider information. It's available to anyone willing to start, apply a disciplined system, manage risk, and let compounding work over time. Extraordinary returns don't come from one-off, lucky bets. They come from consistent, intelligent actions applied over time. Even small investments, when approached correctly, can grow into extraordinary outcomes. The most powerful lesson of all is that starting small gives you control, focus, and an opportunity to learn while minimizing risk. Those who start with limited resources develop the skills and habits that larger investors often lack. Over time, their disciplined approach, combined with compounding and careful risk management, allows them to achieve returns that many consider impossible. It's not about luck or starting capital. It's about approach, consistency, and mindset. Anyone who applies these principles can succeed, no matter how small they are beginning.